Today we're going to go over the mortgage meltdown. So what caused the mortgage meltdown 8-10 years ago? So starting off, if we're going to start off and we're going to operate a bank, why does anybody start a bank? It's not because they're altruistic and they want you to have a place to put your money and make interest. They open up a bank to make a profit because they want to make a rate of return on their money. Same reason why people open up a machine shop, why people mow lawns, why people go to work every day, is because they are trying to earn money or earn a profit. So we're going to keep the numbers in this system very, very simple. All right? So let's say that we get a whole bunch of people together and we're going to operate a bank. And we're going to start with what's called capitalization money. And so we start with $50 million. That's actually going to be a very small bank. And so banks are in the business of loaning money. They do car loans, they do Visa cards, and so they're going to do loans on those. And they also do home loans. And so we're going to simplify this down even farther and just say this bank is just doing home loans. By the way, this is about the simplest that I can explain this meltdown, which will take about, 30 minutes or so to go through. The problem is most people want a 30-second explanation, or even less. They want a 5-second explanation. They want to say, the whole crisis, it's George Bush's fault. The entire crisis, it's Barney Frank and Chris Dodd, the Democrat chairman of the House and Senate banking commissions. It's greedy bankers' fault. It's individual homeowners that bought houses they couldn't afford. But the entire system is very complex and how it broke down. But we're going to simplify it as best we can. So a bank makes money when it loans out money to people. So here we have our individual who wants to buy a house. Under the system before the crash, this house might be valued at $600,000. And then we're going to put a down payment of $100,000. What this leaves is our homeowner short $500,000. So they need to borrow the money. And so what happens? Our bank ships to the homeowner $500,000. The homeowner then ships to the bank title. They get what is called bare naked title. It's very similar to like a car. If you owe money on your car, you don't have the pink slip to your car. The finance company has it. The finance company is the legal owner of the car. The same as if you have a mortgage loan on your house, the bank is the legal owner of the house. Your car, you're the registered owner of the car. The house, you are the recorded owner of that house. Okay, so the bank ships $500,000. Now, the bank, let's say, is going to charge an interest rate of 6% because 6% is what's going on in the market. Banks make lots of different loans at different interest rates with different fees and different points, and there's a lot going on. But we're going to simplify this and say this bank makes all its loans at 6% and charges a 1% fee. So if the bank charges a 1% fee, they're going to make 1% of $5,000 here. They are going to make $5,000 on this loan in fee income. The bank has $50 million. They can't loan and loan and loan and loan. Sooner or later, they run out of money. So the bank can actually only make 100 of these loans. Because once they make 100 loans at $500,000 each, the bank is out of money. if the bank made 1% of $50 million, then the bank made $500,000 in fee income. And it's just coincidental that they're making $500,000 in fee income and our loan amounts are $500,000. So out of this $500,000 in fees, the bank has to pay, say, $200,000 in overhead. And they also, let's just keep it simple and say $200,000 in loan losses, which means the bank is going to turn a profit on these of $100,000. Now, banks are not in the business of holding loans and sitting there and collecting your interest. It's not what banks do. Almost all banks, including Wells Fargo, Chase, Bank of America, the big mortgage brokers at the same time, they sell those loans. The loans have value because they're paying interest. So in comes Fannie Mae and Freddie Mac. These are the huge behemoth buyers of mortgage loans that were set up by Congress specifically to buy mortgage loans, and they are also allowed to raise money. We'll get into that a little bit. But what's going to happen is these 100 loans are going to be sold to Freddie Mac. So now they have the 100 loans. And they get the interest on the loans. They also have the risk of default. The bank, which was out of money, now has sold these loans, and they sell the loans for $50 million, and now the bank has its money back. And so the bank completes this cycle. Every time the bank can loan out all its money, sell the loans, keep the fee income, pay the overhead, they're going to make $100,000 each time they complete this cycle. And so the faster they can turn these loans, the better. Now, some people might say, well, you know what, I had a loan with Chase or Wells Fargo or Bank of America several years ago, and I still make my payments to them. Typically what happens is the banks retain what is called the servicing rights. So in other words, Freddie Mac doesn't want to take in all the documents and take in all that stuff and enter it into their system and send out bills and do all that tracking. Chase or Wells Fargo that set up the loan, got all the information, they already have all that stuff, are going to service it. You send your check to them, they record it against the loan, and let's say that you're paying $2,500 a month for your mortgage. They'll take $2,480 and they will forward it to Fannie and Freddie, and the bank will keep $20 to pay for their overhead and servicing and customer service and stuff like that with the loan. But the owner of most loans here is Fannie and Freddie Mac, the mortgage giants. Okay, so then you're probably saying, well, all right, but where the heck does Freddie and Fannie come up with the $50 million? Does Congress fund this? The answer to that's no. Congress doesn't fund it. Freddie and Fannie, by Congress, are allowed to issue bonds. So what they'll do to support this $50 million is they'll go out and they will issue $50 million in bonds at an interest rate. If the interest rate here is 6%, they'll go out and issue bonds at like 5.7%. So they're going to sell bonds, and Freddie and Fannie are going to pay interest of 5.7% on the bonds. So from Freddie's perspective, they borrow money at 5.7%, so they can buy loans that yield 6%, and so they make the spread of 0.3% on these loans. Now, you're saying, boy, 0.3%, that sounds horrible. That's like nothing. Well, it's not a big spread However, you multiply this by the trillions and trillions of dollars they have, and all of a sudden 0.3% on $3, 4, $5 trillion, that sounds like a lot of money. And they actually are extremely profitable. And so Freddie and Fannie have to raise this money by selling bonds, so they have to sell them to somebody. And so who typically buys bonds? Well, we've got our two largest mutual funds, Vanguard and Fidelity. They run lots of bond funds. We have CalSTRS, the largest pension in the nation, California's teachers' retirement. They're buying lots of bonds because these bonds are actually very, very safe bonds for the most part. Also buying into these bonds are big giants like AIG, because that insurance giant has hundreds and hundreds and hundreds of millions of dollars that is set aside in reserves in all different types of accounts for different disasters, large fires, earthquakes, hurricanes, floods. So they need to park an awful lot of money in safe instruments, and they have to be able to liquidate $1 billion overnight to pay claims if they need to. So they're going to buy a lot of these bonds. So the bonds then go over to AIG, CalSTRS, Vanguard, and Fidelity, and they're going to hold those. And AIG, Fidelity, CalSTRS are going to buy them, and the $50 million goes to Freddie and Fannie. Now, where does CalSTRS, Vanguard, Fidelity, and AIG get all their money? They get it from us. It all comes back to us, almost everything that's going to be paid for. If we're building new roads, it's paid by us. If we're funding new defense programs, it's paid by us. If we're funding new social programs, it's paid by us. These bonds, this money, it comes from us. And it's going to come from these individuals. All right? If this person's a teacher in the California Teachers Program, then they're earning money. Some of their money goes into CalSTRS. CalSTRS then buys bonds to pay for their retirement. If they have an individual 401k plan, and we've got 3 or 4 people in, say, Fidelity and Vanguard fund, and they're putting in $500 every single month, saving for their retirement, or saving for 5 years from now when they want a new house or a pool or whatever it is. All right? So this is building up and building up in their account. So you'll see on Fidelity, they'll get a statement. They have $1,000 in bonds, $20,000 in bonds. Here, AIG, on their balance sheet, they might have $4 billion in bonds sitting there, waiting to be liquidated in case of emergency to back them up. So this entire cycle is very cyclical. So this person over here who's buying these bonds, they're buying the bonds at 5.7%, but Vanguard and Fidelity, they charge management fees, and they usually charge about 1 to 0.2% in management fees, depending on which type of fund it is. And so this person over here is going to see a yield on their bond of, let's say, 5.5%. Actually, this system is very, very efficient. From the time that this person over here went out and paid 6% to get a loan, and then that loan cycles all the way through the system, through everybody's hands, we only lose about 0.5% over here on the other side. The crux of this system is that this person pays their mortgage. The way this system is set up, especially pre-crisis, this person had to have A plus, or A minus credit. and they tended to need to put somewhere between 10 and 20% down. But Congress got together and they said, hey, we don't think this system's fair. People without good credit are locked out of buying a house. People who don't have money for a down payment are locked out of buying a house. Somehow we got to make this system more quote-unquote fair for them. And the way this is set up now, if this homeowner, if they lose their job, if they're getting a divorce, or anything like that's happening, they have $100,000 in equity in this house. That's their money. If the house has gone up in value to, say, $700,000, then they're sitting on $200,000 of equity. If they sell the house for $700,000, they pay off the $500,000 loan, they keep the $200,000. This person has an incentive to keep the house in good shape, and if they can no longer afford it, sell it. Don't rack up a bunch of attorney fees. Don't break the house up into 27 pieces. Don't flush cement down the pipes because they're mad that they're being foreclosed. They're not going to do any of that because all that's going to come out of their $200,000. So what they ended up doing is lowering these requirements to where a person with about B to B minus credit could get a house. And we lowered this in a lot of instances down to about 3%. And so that meant they only had to put in about $18,000 into the house. So they don't have that much equity in the house. Freddie and Fannie weren't necessarily hip on this idea, but Congress ordered them to lower their standards so that more houses would be bought. And it was a political decision. A lot of it was driven by George Bush. He wanted the highest minority home ownership rate of all time when he left office. Barney Frank and Chris Dodd, the Democrats, they wanted low-income individuals to be able to buy houses. And so, therefore, this was a political decision, not a financial decision, to lower the standards of the buyer. Okay. As soon as you take and say, the only people that can buy houses are people with A credit and $100,000. Not necessarily a lot of people. When you lower that to B credit and $18,000, now a lot of people could buy. When a lot of people can buy and a lot of people want to buy, then that drives up housing prices quite a bit. And so housing prices went crazy for a while, as we all know. And so this house maybe went from $600,000 up to $900,000. And I only have to put 3% down. In fact, sometimes even less than that. So maybe I'm going to put $20,000 down. So I need a loan of $880,000 from the bank for this house. Now here becomes the real problem. If the homeowner gets into trouble, it does cost money to sell your house. And so this homeowner is already underwater. It costs about $50,000 at least to sell a house, depending on the size of the house. And so this person's already what we call underwater, $30,000. If they sell the house, they will net less than $880,000. So this owner, if they're in trouble, if they're getting divorced, if they've lost their job, they no longer have an incentive to sell. Actually, their incentive is to stop paying and stay in the house as long as they possibly can and get free rent on the bank's dime instead of out of their equity. So when these defaults came through, they just refused to move. Then the sheriff would go out and say, we're going to move you out in 2 days. Then they would file bankruptcy, and so they could stay in this house for a year. So then what happens is that losses start to mount, and income from these loans that are being paid to Freddie and Fannie starts to dry up. Their income falls. Their loans go in default. They issued all these bonds, and then Freddie and Fannie say, I don't know if we can make the interest payments on our bonds because our income from our loans has dropped so much. These bonds then go from being very safe to not performing or potentially in default. All of a sudden, values drop 40%. And so where I had $1,000 in bonds over here, all of a sudden, I have only $600 in bonds. I lost $400. AIG that had $4 billion in reserves, now that's been cut. They've got like $2.4 billion in reserves. CalSTRS actually lost $1 billion in this fund. But luckily for all us teachers, CalSTRS is backed by the full faith and credit of the state of California. So therefore, all of you guys as students will be making up all that shortfall from this crisis. And so don't worry too much about me. I'll be okay because I know you're all concerned because that is actually incredibly important. If we can't pay these bonds, the value falls, and are CalSTRS, Vanguard, and AIG, are they going to buy more of these things? No. Am I going to put more money of my retirement into the bond funds? No. So then what happens? Freddie and Fannie cannot sell bonds, which means they cannot raise cash. If they cannot raise cash, they can't buy loans from the banks, which means the banks are out of money. And the banks that made all these loans, that thought they could take these loans that were horribly performing loans and lay them all off on Freddie and Fannie, are stuck with them. So now the banks are stuck. The banks are out of money and stuck with non-performing loans, and now the banks are in trouble. All lending starts to dry up. You can now only get loans if you've got pristine A-plus credit and you're putting 30, 40% down. Because you can't get loans, all of a sudden the price of housing collapses, exacerbating this problem. Now the value falls from $900,000 back down to $600,000, but the loan is still $880,000. Now the bank's losing $280,000 on this loan alone times the number of foreclosures. It was huge. Just huge. So Freddie and Fannie are in trouble. The banks are in trouble. We're not buying. And so how do we get out of this mess? Now, you can argue all you want about the next step that George Bush decided to make, but really all financial analysts say this was about the only choice. What they did, and we can argue a lot about this number, and different amount of money went to different institutions and kind of went all over the place, but we're still kind of just simplifying it. Government comes in and injects money into Freddie and Fannie. They inject about $1.6 trillion. And depending on which analysis you believe, that means it cost every single individual in the United States somewhere between $5,000 and $15,000, depending on how you do the accounting and depending on a number of factors. So now Freddie and Fannie have money, which means they can pay interest on these bonds, which means the value of these bonds starts to return and go up because they can make their payments. AIG doesn't all of a sudden have reserve requirement problems. CalSTRS, their losses are mitigated to a certain amount because value returns a bit. And same in these individual accounts. Some of the value recovers. But more importantly, Freddie and Fannie have cash, so they can now go to the banks and buy loans so that the banks have cash. If this wouldn't have been done, this would have been a complete meltdown. Because money was so tight that in the U.S., most domestic manufacturers stopped leasing automobiles because they weren't sure about the asset worth 3, 4, 5 years from now, and so they just didn't lease them. You had lots and lots of small businesses that needed working capital loans. In other words, Boeing comes in and Boeing says, hey, here's $1 million order. As soon as you give us these parts, we'll pay you $1 million for them. And so then the individual business owner comes down to the bank to get a working capital loan and says, look, I got $1 million PO from Boeing. I need to buy $300,000 worth of materials, and I need $300,000 to pay my employees for labor to make these parts. I will then ship them, get $1 million, and I will pay off the $600,000 loan plus interest, and we made a bunch of profits. And the banks go, we don't have the money. We can't loan it to you. That's too dangerous. We can't extend ourselves. We got to worry about keeping our doors open. We got to worry about capital requirements because we're getting hammered so much. And so now businesses are turning down business, which means they're laying off employees, and we're looking at what is going to be a spiral down. Individuals who were using equity within their house to fund businesses saw their equity lines of credit chopped. I had a $150,000 line of credit on my house, which I kept just as an emergency fund. Just in case life went horrible, I could always write a check and pull out some cash. One day I get a letter in the mail and I'm notified that my line of credit went from $150,000 to $1,500. And the reason that they did that is all the values of the houses were falling, and the bank said, hey, whoa, we don't want this exposure. We're already in trouble. We got to cut all these lines of credit. Now, if I was a small business owner and I used that line of credit to help finance my company, all of a sudden I lost my financing for my small business, and we're in big trouble. So it took about a year and a half until there was enough faith in these bonds that people had started to buy. Plus, it took a while for all these bad loans to shake their way through, so the new loans being bought were much, much more high quality, although there's certainly still a lot of foreclosures. Now, one more thing I'd like to say about this system, and I know that there's way too much color going everywhere. Now comes an awful lot of naysayers and people later on that are saying, hey, you know what? We just injected $1.6 trillion into the market. Why didn't we get ours? You know, I need help with my house. The bank's got $1.6 trillion. They should give me a loan. They should forgive my loan. They should mark my loan down from $900,000 to $200,000 and forgive all my back payments. The problem with that is this $1.6 trillion, do the banks have it? They don't. A lot of that money went into recovering here. An awful lot of this $1.6 trillion just vaporized when the banks had loaned $880 million and lost $280 million, $300,000, $400,000, $500,000 on these loans. This money doesn't exist. This money just basically got us back to where we needed to be. The best example I can give you is, let's say that you get into financial trouble. You owe $10,000 on a credit card. You're 3-4 months behind on your rent. You're behind on your car payment. You need car repairs. You got all this stuff going on. You got to pay for school. You haven't been able to pay for books. Someone stole your shoes. I mean, things just are not going well for you. and in comes Grandma. And Grandma writes you a check for $30,000. You are so excited. And you deposit that in the bank. You pay off the Visa bill. You pay for school. You buy yourself some new shoes. You catch yourself up on the car payment. You do your car repairs. And you pay off your rent. And after you do all that, you have $2.87 left over. Then your friend comes to you and says, hey, you know what? I heard your grandma just gave you $30,000. Man, let's go to Vegas. And the person's going, what? I don't have the $30,000. It's gone. They're going, no. You just got a check for $30,000. I know you're loaded with money. Let's go to Vegas. You're paying. You're driving. Let's go. The person's in an argument saying, hey, we just paid off our loan losses. We paid off our expenses. There's no money left over. And there's not. If we turn around and a lot of people, what they want to do is go back to the other system and give more people a break and lower standards, because right after this crisis, one of the very smart things that was done is we went back to A credit. Because when we looked at the default rate of the individuals, it had a lot more to do with quality of credit than it did with the size of the down payment. In fact, it's a lot easier to get smaller down payment loans now than it used to be, because that wasn't the risky problem. The risky problem was low quality payment history. So we certainly don't want to do that. If we relax lending standards again, we're just going to end up in the exact same mess we were. All right. Thank you very much.